Well, Dr. Turner, thank you so much for making the time to jump on here with me. So, you wrote a paper. I read the paper, then I had to reread it 3 times to fully grasp it. And I think I still might only 20% understand, all the details of what you have going on. So, right out of the gate, tokenization, you seem to be passionate about it. What is tokenization?
Yeah, okay. So tokenization is a process by which you take an asset and rather than dealing with that in the investment space in a traditional way, you can create tokens and attach the economic and the ownership rights of the asset to the token. So in a sense, the token acts kind of like a share of the actual asset. So if you're taking any asset and it's got a shareholding, the token kind of replicate what the shareholding would do, in theory, and then in practice that's really different, of how that works. So the paper that I wrote recently took the word tokenization and said, you know what, there's a lot of different meanings and a lot of different perspectives of what's going on when someone uses the word tokenization. And actually, there's 4 distinct categories from my perspective of what tokenization actually means, and actually then taking the time to understand what do those 4 categories actually mean and what's going on when you use this type of tokenization against that type of tokenization actually then creates a lot more clarity from a legal and a financial perspective, which is helpful then to the market.
Okay, so there clearly tokenization has been around for a while. And so is it safe to say you've just identified some pretty serious issues with the current model of tokenization?
I don't think I've identified issues. I'm just more asking questions around what is it that people mean when they say the word tokenization. So, someone can say the word tokenization, and what they're meaning is that the token refers to the asset. It's got a referential claim. So, I could say, okay, I've tokenized this building, and the actual person that owns the building is still the owner of the building. The token just represents a right to claim on that particular asset. But when the chips are down and the legal enforcement comes in a moment of economic downturn, my fear is that the person that has that token doesn't necessarily actually own the underlying asset, so they actually won't get any money back. And I think a lot of the market sits in that space, which is again, that's my perspective. I'm not saying it's true for every type of tokenization, but it's a concern. And then the second type is of tokenization would be contractual tokenization. So I actually have a contract which is attached to that underlying asset. So I've got more of a legal claim on what's actually going on. I may still not actually own the underlying asset. That might be locked up in a different special purpose vehicle, but at least I've got a contract which shows that I've got a degree of economic
Yeah.
connection to the underlying asset. And then the third type of tokenization that I think exists is what I would call title tokenization, where actually fully, the token is the asset is the token. Um, there's still an underlying legal structure that binds those two things together, which always has to be the case in tokenization because these things, real world assets, it's kind of almost a moot phrase because real world assets are assets that are in the real world. So you've got to have some kind of legal structure that sits beneath it. And then the fourth type of tokenization I would call more like atomic tokenization. And really that's when it's that there is no need for a legal structure because when I say the token is the asset is the token that's fully bound together on chain without the need for kind of um, an external legal structure. So, native cryptocurrencies would actually operate in that space. Like Bitcoin has no central authority, it has no legal jurisdiction. It's just a token that represents what it says it represents. It's got no external reference point. It's just natively there. So that happens atomically on the chain, on a blockchain.
So would you say that the majority of so if you look at blockchain projects across the board, majority of those are title tokenization, would you say?
No, I'd say the majority of tokenization happens at either the referential or the contractual level. And then there's really just 2 or 3 solid examples currently on the market that have happened at the title level. And so it's
Okay.
quite rare and it's specific to individual use cases in specific jurisdictions around the planet. So examples would be the Swiss have developed a backed distributed ledger technology for assets. The Germans have done it as well. And there's been one or two small examples out of Dubai in the last 12 months that it's already the first time you see the ledger acting as the asset acting as the ledger, and it like the two are kind of like completely bound together in a particular SPV.
So, which sectors or what asset class would you say is kind of leading the way in tokenization right now?
Stablecoins could be considered in a sense to be tokenized products, and they really operate at the referential level, right? They're referring to the US dollar in a treasury bill. You don't necessarily own the treasury bill, but you own a token that's backed by by the company that has issued the stablecoin.
Mm.
So that would be kind of like a very solid example of, in most way, the same way you hold a dollar in your bank in your hand. It's referencing to the Treasury Department of the United States government that that dollar is worth a dollar, right? And so referenced tokenization would probably be mostly aptly described by stablecoins and other assets, money markets, and money markets, and then also securitized EFTs have been tokenized in this last period of time quite successfully, and then there's more exploration into real estate, commodities less so, but those would be the kind of the predominant markets that have been tokenized at this point.
So, in your paper, I think one of the central questions of your work really goes back to um, where does authority reside? And I even now kind of hear you pointing towards that. But can you expand a little bit of why is that such an important question?
Yeah, it's okay. It is a great question. It is the key to what that paper is trying to identify. Is at the end of the day, you can tokenize across any of those four categories, but the real question is like, who has the authority? At the end of the day, I can send a token to you, and you can send a token to someone else, but what actually has to happen off chain to validate and back that transfer? So in a referenced tokenization process, the authority has to go through multiple steps for the asset to actually carry over. So I can transfer a stable coin, for example, a dollar from myself to you, but the authority that sits behind that sits in legal structures that verify that on chain and get essentially gets priced into the overall process. At a contractual level, there's a lot more. So I can leave a token that's based on a contractual tokenization, say on a piece of property, but until that property's been checked, verified, contractually drawn up, transferred to from A to B, that token's got little to no value until that authority work has been completed. When you until when you exchange a house, until you swap contracts and you actually hold the title deed in your hand, that proves that you then have the asset, right? There's more work that goes on outside of the transaction that proves the transaction's happened. And so this idea of like, where does actually authority reside in tokenization is really important, because until the off-chain mechanics have actually happened and the transfers happened, moving a token on the blockchain is almost kind of moot, until
Mm.
you know that everything underneath that process has been completed. You don't actually own anything, and that's the question really that belies tokenization. Now, it doesn't mean that we're pushing towards what we call title tokenization, where the actual asset and token are bound together, and that's recognized by a particular jurisdiction, and that's what we're kind of piloting and trying to move to in terms of proof of concept, um, in a more agnostic way than the specific examples that I mentioned earlier. But at the end of the day, and until you know that A has moved to B, you can't be sure of what's going on, and so it's really important, and therefore you have to price in that latency, or that amount of work that goes on behind the actual token transfer. You have to price that into the actual process of tokenization, and I think that markets don't do that, and that creates then several problems. So there's real world promise from my perspective in tokenization, and there's it's the hype. I think at the end of last month, at the moment, there's about $31 billion worth of assets that can be pointed to on chain in terms of tokenized assets. But the larger institutions that are talking about tokenization are predicting trillions and trillions of dollars worth of assets going on chain in the next 5 years. Even up to like there's numbers up to 13 to 30 trillion dollars worth of assets going on chain. So there's a huge movement, and it makes sense, because why is that change going to happen? Well, because the blockchain's a really, really good record and a very clean immutable, transparent, and accountable way of actually recording these things that are traditionally recorded offline, off chain, in ledgers inside companies. But it's a much more powerful technology, right? Because you can actually prove and point to those transactions. So it's definitely got utility in terms of the openness, transparency, and the immutability of what tokenization does.
Kula recently announced a strategic agreement to explore regulated tokenization. Unpack that for us. What does that mean exactly?
Yeah, so we're running a proof of concept to really work with our regulator in the jurisdiction in which we work to really attempt to see if we can do title tokenization on a particular asset, but in a what I'm going to call it in an agnostic way. So if we can get the structure right, that can be applied across different examples, across different industries. So whether it's real estate, whether it's a commodity, whether it's a fund or money markets, we can look at tokenization at the title level across all of those different particular types of tokenization of particular assets. So we're running a very small proof of concept to attempt to do that, where the ledger is actually then considered to be the actual final point of authority, and that's recognised then by the regulator. So we're running a small proof of concept, working with both the client that they're actually tokenizing the asset for, and then with the regulatory space that we've got the structure, the background structure in place legally to do this, and then presenting that then to the market. Say, look, we've piloted this, we've proven that we think we've got the concept worked through, and we're actually able to achieve it and deliver it. And that's kind of the work now for the next couple of months. So we've got all of the players in place, and we're now in process of doing the legal structuring. And next month we'll then start rolling out the technological side of that process as well.
Is anybody else doing this? Or what's the unique factor with Kula?
There isn't a unique factor with Kula in the sense that we're first, because we're not, and we're not trying to claim to be the first ones to do this, because that's not true. And there's some really good examples in the planet, like I mentioned earlier. So the Swiss and the German authorities have developed ledger technology. There's a lot of work going on in Luxembourg right now in this space, and there's been a few dedicated and specific focus projects happening in the United Arab Emirates, and that's all doing what I'm talking about. The interesting thing about all of those is that they are proof of concept stage deployments, and they're happening in a very bespoke way. So particular businesses developing their specific tech stacks to deliver these projects in specific jurisdictions for specific clients, and there's nothing wrong with that. That's great. And proof of concept is always like, okay, we're going to try it in a very limited type of space. Is it going to work, and what can we learn from that process? And I think that proof of concept has been evidently it's observable, and there's news articles, stories, and those companies are doing really well. So they're a little bit ahead of the curve. And I think what's interesting, again, it's all very specifically focused, and I know that those companies and those businesses, and the various different authorities that are working in this space are delivering those proofs of concept so they can expand it and grow it outside of those specific use cases. And so we're following that. We are following it. We are following a trend, but we're quite early in the process because we've got quite a unique legal structure with the group structure that Kula has that allows us to kind of to be a little bit more allowing us to kind of move more quickly into this space, which has been, I would say, some happenstance and some really good work that our partners have done with us and on our behalf, with the regulator. And so that what we're doing then is essentially we're building out a process that's a little bit more agnostic straight away. So it allows us again to work with various different asset classes across various different industries and tokenizing those processes in a more open and hopefully global way. So we're, again, proof of concept, and then that's the next step. But we're working with that structure in place so that we can be more broad and give more scope to these processes, hopefully here in the next 3 to 6 months.
So how does regulated tokenization fit into Kula's broader model and vision of what it's all about?
Yeah, I think from the get go, with building out Kula, we've wanted to follow and ensure that we're regulated and legally compliant in what we do, and it's a really tenuous space working in blockchain because there's so much scamming and hype that goes into the cryptocurrency space, and we've all heard the stories over the last several years of companies that are here today, gone tomorrow, and the retail market's just left wondering what on earth just happened. And we've wanted to make sure that we're in a space where, from a regulatory and compliance perspective, we've always been as watertight as we can be, and not just in the compliance financially, but cybersecurity, retail market expectations, and that's been something that's been very very consciously covered off in how we've approached what we do. And so, as we come to the issue of tokenization, working in a regulated framework and making sure that the underlying mechanics of the business operate in a regulated space is really, really important to us. And so by doing that, we're continuing in the same perspective that we've always wanted to. And making we've been quite deliberate. So whilst the Kula token and our licensing allowed us last year to launch the Kula token, and we've been very deliberate understanding the underlying mechanics legally in our structure, and also then applying for new licenses to be able to do this. And so we've been working on this process in the last several months. And again, it's not easy and it takes time, but being deliberate in those processes is really important, because at the end of the day, we don't want to get it wrong, and we don't want to end up outside of the lines that are there for a good reason. So that's kind of why we've been following that process of making sure we work in a regulated space.
How does this affect the Kula token, or does this affect the Kula token?
Yeah, I think from the initial thesis that we started out, and we've always been really clear that we're an impact investment company, and at the end of the day, the projects that we're investing into, the businesses that we inject equity into, our concern is at the grassroots they're making an impact and changing
Mhm.
lives. That's kind of our core thesis. Tokenization sits around that, and so we can work with third-party clients and provide those services externally. But also, we're working in spaces by doing that are then having an impact. So the beauty of tokenization is that you can add all sorts of great things to the contracts that provide the space to do tokenization of those assets. So you take a third party that's working, say, in a particular commodity, and we tokenize it. We can bake the impact metrics and the impact concerns right into the core of what the token's doing, so that the what's happening at the grassroots in terms of change lives, change environment, social good, those different things are demonstrated right through the project, and then show up in the token and the way that those contracts are written. So and then from the get-go, yes, impact investment, but also then if you look at our initial business plan, and we were always clear from this from the beginning, we provide those services to third parties, and in providing those services to third parties, we can take quite lucrative service fees and ongoing stakes in the underlying assets as part of the service process, that then generates good profit and good return for the business overall, and then that essentially allows us to operate at next to nothing as we start covering the operational costs in time. It's not like it's going to happen overnight, but over the next 12 months, that's where we're headed with this part of the process. So we're building a business model that creates income and revenue from providing those services, both service fees internally, but also then positions in the tokenized equities and commodities and whatever it is that we're tokenizing, that goes immediately into the Kula treasury, that then has has the same impact from investing into equity in the different projects. Alongside that, it provides return for the business, and that's kind of the goal here.
So while it doesn't affect the existing token, a Kula token, it does have the potential to have an impact on the Kula treasury in a positive way.
Yes, you're absolutely right, because the overall thesis of the business plan was to be generating profit from the investments that we invest into, but also as providing services, that then gives us that income to cover operational costs, but also be returning the value to the treasury for the sake of token holders.
Looking ahead, I know you're not a predictor, or we got to be careful about our predictions here. But what do you think needs to happen across governance, regulation, or even just the infrastructure for tokenization to really work?
It's a great question. So, people, the promise of the market in terms of tokenization is like, we open up secondary liquidity, and there's going to be all these new markets that are created through tokenization, and it's a true statement. It's a truism. But if you look at, say, Build, which is one of the first securitized tokenized tokens at scale, I think there's like 25 wallets that hold that token and barely any secondary market. And that's partly where it comes back to the question of what type of tokenization are we talking about here? Because it's all good and well to buy a token, but if it's illiquid and you can't sell it to a secondary market, what's your exit strategy as an investor? And that's really important, right? And that's not necessarily possible because some of the problems that I've been talking about and we're identifying in tokenization means that, if you don't know where the authority resides and you don't have an asset that can be verified on chain immediately, then there is no secondary market for it because no one can trust that that token is actually bound to an asset that it says it is connected to. So in solving for some of those problems and trying to address those issues then creates more standardization across the market and the ability for various different players to verify, okay, the asset is really real. It really does reference this, or it is really connected to this particular asset. So there's a large gap in the promise at the moment of secondary liquidity, which I think is one of the biggest issues in the space of tokenization that's got to be solved for before it's really mainstream. There's also a good argument, to not use that type of tokenization in everything either. So, where you don't want to create a system where all of the shareholders, on particular assets, it's not necessarily best that all the shareholders have a large voice in directing where a particular large scale real estate project is going. And that might be more appropriate to stick into a more contractual referential type of tokenization structure. So what I'm talking about in terms of title tokenization isn't a catch-all to solve all problems. It's a larger solution for more institutional scale money to say, look, if I can verify the asset, I can understand its impact, so I can meet my ESG metrics. And like in Europe, if you're investing into a particular asset and you can't prove, for example, it's not caused deforestation in an emerging economy, then you are liable for very, very large fines in the European system. That's not necessarily true in North America at the moment, but there's regulations that cover Europe that if you're a large scale sovereign and or institutional project, you've got to be able to verify those things. And so tokenization is not even a possibility because at the moment tokenization doesn't provide the verification of that type of impact on financial flows. So there's problems to solve, right, in terms of where the money global or where the global capital can be deployed and how it is deployed, that tokenization in theory solves, but in practice, until these standards are baked into the actual underlying smart contracts, there's still a question mark for me anyway of where the market sits and how it can actually access and use that capital well, and then report on it with verification in a way that satisfies multiple forms of regulation. So again, we're working at those types of problems in Kula and solving for those problems. And again, the market isn't there today, but the market is moving in that direction. So someone's going to solve for these problems. So our perspective in Kula is like, well, it may as well be us, or we may as well be part of the conversation that's moving that forward. That positions and hopefully allows Kula to, be increasingly influential in the space. That's of course our hope, but it doesn't detract from the wonderful work that many other organizations and businesses are actually working at. And we're approaching that space in a collaborative, supportive posture because we want to be part of the conversation with everyone else, but also support everyone else's efforts too. Because as these other businesses get there, so that makes our role and our job also easier as we work in this space. So it's really a case of like, how can we partner and collaborate and bring what we're creating and developing to the larger table and have an influence and impact, but also draw on the impacts and the leverage that other businesses are creating in this space as well.
I love it. Well, this is exciting. Is there anything I'm missing? Is there anything that we should know about what Kula's doing around tokenization?
Large scale sovereign and institutional capital is looking at tokenization, knowing that it needs to get engaged and involved, but there's several hurdles and obstacles for them to really get comfortable with utilizing it and deploying capital through those rails. And they're really important and necessary large scale questions that at the moment there are emerging solutions for them, but nothing's kind of integrated in that sense. And that's definitely something that we're not just able to start addressing through the regulated structure that Kula finds itself in, but we're also working hard at building out technological solutions that can be standardized across the market and allow for multiple tokenization engines, software services, and service providers to actually utilize, and also further utility of their products as well. And so I think we're working as hard as we can to contribute to the market that way, and identifying, categorizing, and identifying around what a taxonomy, like a taxonomy is a fancy way of saying like categorical understanding of what these different things are doing, and creates the ability to think and structure things in ways that everyone can say, okay, we know what we mean by that, and we can understand what we mean by that. And when everyone's in agreement around a particular type of taxonomy, then you can create solutions that everyone understands. And at the moment, that doesn't exist. And so part
Mm.
of just the conceptual work that's going on behind what we're building is as important as actually the products that we build themselves, because they're able to identify those different components. And so what does a sovereign nation want from tokenization? Well, it wants, like I was with a regulator in East Africa recently, and their largest concern was tax revenues. So if I've got a particular asset and I divest of that asset, there's a taxable event right there. If you tokenize that outside of any understanding of that necessary process for a national state, they don't want tokenization to come into their country until they can actually verify those types of processes and do their tax capture, which of course is important for a nation state to develop its roads, schools, hospitals, welfare system, whatever it needs to create, right? So it's a valid concern, and again, we're wanting to create those types of standards and processes that allow for that conversation to happen, for that nation state to get really comfortable with the idea of tokenization, and actually then draw on the products and services that the market is providing, because they can be confident in it. And that's an
Mm.
important, that's one small example of why it's an important process to engage. Um, I think again, I use the example of impact and the European standards, and the need to prove financial flows address the impact at the grassroots, but also like how does an institution, how has a fund ensure that it's it's daily rebalancing of the actual assets, that it's controlling the net asset value. um, Oracle's that often operates in a bespoke software solution, but what if that can be standardized and actually built into the actual underlying smart contract at the infrastructure level, is a question that we've been asking, and wondering, is that something that we can address and look at. And so again, we're trying to push forward in the thinking in these spaces because of we hope a clearer understanding of what's going on inside the word tokenization, which then means that we can offer those services in a really concrete and well thought through way for multiple jurisdictions, multiple clients across multiple different jurisdictions. One of the biggest concerns in virtual assets is, and it's solved for at one level between holders. So if you're transferring assets in your wallet to a counterparty in a different jurisdiction, we need to verify and check, legally, is that possible? And so that you can be verified. You can go through your know your customer and
Mhm.
anti-money laundering checks, and your counterparty can too, and that can all be verified and checked. And then once that's checked, the token can move, and the actual authority that could the authority completion in that transaction um, will happen. But what are the jurisdictions that you're in North America right now, and maybe you've transferred a token to someone in Zambia, but what happens if Zambia does not allow that transaction to be returned, or there's other
Mm.
jurisdictions that transaction cannot be returned to because of Zambian law? Well, we can actually work at understanding that at the level of the token, and not just the actual holder.
I think especially in a world where we're working with, I feel like we learned every week that there's new sanctions going out and that sort of stuff. So just a little bit of, I would say, protection around token holders is a win.
It's really complex. It's not simple and it's not easy. But if you were getting me up here to talk about the grey list and FATF compliance in law and finance and tax, it would be as complicated, because it is that complicated. So it's not like, oh, we're trying to make this really complicated because it's bamboozling. No, what we're trying to do is utilize blockchain technology as a new technology that addresses existing structures. And in order for institutions and significant capital to be deployed in tokenized products, we have to grapple with these things. otherwise, they'll never adopt it fully and completely, because they can't, because they've got to check all these compliance boxes. And so either we do the hard work, or others do, and others are. So we're part of a group of international businesses that are working in this space and trying to solve for these problems. But again, if the promise of trillions of dollars of tokenized assets going on chain is going to be realized, they've got to be fixed. And we definitely want to be part of that conversation and that market trend.
Well, thank you so much. Thanks for helping us understand a little bit more, just not just the complexities around tokenization, but the potential and where we're going. And I love that Kula is helping to pioneer a path forward.
Thanks, Lance. It's been great to talk to you about this, and yeah, we're looking forward to what's ahead.
Thank you, sir.